How's everyone doing today? How are all the face fanatics doing? My trading warrior brothers and sisters, how are you? Everyone doing all right? So I got a haircut to remind me not to take a haircut, my fuzzy, on the BOE or the NFP. So just want to show you with all the different pairs that we're trading, that we're covering now, look at all these different patterns in play, okay? So there's plenty of action for subscribers and across the board for the different works, NIX, CAD Yen working, Blake, Euro Kiwi, Aussie Kiwi by Grega, another one by Blake. We have a macro by Stelios here in Pound Kiwi, and USD MEX hit targets. So nice trade, Blake, very patient, was getting long down in here, held through this retrace, held through this retrace, targets achieved. Everyone congratulate our CEO, Blake Morrow. So the DAX PIP work, pattern in play, and now the peso trade working. So, and the whole team working for everyone here, every day, all during the day, and through the night. Okay. So I'm off camera here. Let's take a quick look at the dollar. Still think the inflection point might be on the NFP. Euro made a marginal new high, and this time it did diverge under 75. So looking a little bit more negative here on the RSI structure. As you could see up here, there was a lot of mo. I'm sure Blake scalped it well for about 40 pips if I know him. Maybe there's another run up. And regarding the pound, it's kind of a push trade here. At the most, give it until the BOE tomorrow. We really need to close back under 190. So I redrew the return line, the wedge line here. And as you can see, we had a pullback to the wedge line, and we need to close back in it. So we'll see if that can happen before the BOE. But I do suggest standing aside or having no more than a half position on into the BOE. We'll see if that's going to be the catalyst for the dollar. I'm looking at some of the yen crosses. Pretty nice divergence in Euro Yen here. Made new highs. A lot of people are going to call this a breakout here. Guppy much weaker. Just took out the stops here. And I'd keep my eye on the Aussie Yen. If we get one more rally here, maybe this is A, B, C, could be a shorting opportunity for maybe a right shoulder up here at 89. And with that being said, CAD, trying but not convincing yet. This was a confirmed low. And the Dixie trying to grind it out, but I really don't think there's going to be any major commitments. US dollar yen, maybe, but still no real signal of a dollar bottom here. So this type of quiet sideways action is, to me, more of a lack of interest. It being August and the NFP and BOE in the next couple of days, I'm really pointing towards Friday, and be here Friday with our new hours. We're going to be here for the NFP number. Also on Friday, Chris Laurie's going to be our guest, and he's the king of the carry trade, Aussie Yen. So maybe we'll have an Aussie Yen short in as a coincidence for Chris Laurie being here on Friday. So Blake, I don't have that much more to add. Pretty quiet board. How are you today?
Good. I wanted to say nice haircut. Looks good.
Thanks, buddy.
I got a haircut yesterday too. I buzzed off a lot of hair, so it's yeah, I went from shaggy Blake to squared away Blake. So
Doesn't it feel better in the summer? You feel lighter. I feel
yeah,
lighter.
it's
You
it's
know?
it's it's so warm here that it's nice to get.
It's a steam bath here today, Blake. You know, I'm sure you have monsoons because we had torrential rain. I even lost power yesterday afternoon.
Oh my
Right
gosh.
before, right before the RBN, the New Zealand Bank, Central Bank, made
Yeah.
their announcement. So, you know, someone on Twitter said red alert, and I laughed I said, oh, I'm scared.
Wait,
And right
who
when
wait wait who made their
Kim at Price Action, Kim had, you know, a tweet about a red alert on the New Zealand Central
oh
Bank.
oh no, that was employment. They had
Oh,
employment.
was it employment? Oh, okay.
Yeah,
All right.
it was a horrible employment number, by the way.
Yeah, anyway, my power went out on that release. So
Oh.
anyway, yeah, power out when it's warm. So I'm wondering what you're thinking here. You know, it almost got to that number that originally you were talking about, 118.80.
Yeah, this euro, the euro dollar, basically, if you look at the low here from 2010, the low was 118.76 or 77.
Yeah.
We came within 10 pips of that overnight. We came
Right.
to 118.70. Now I got asked earlier in my chat room, the like private chat room. It's not open to anybody. But I got asked, hey Blake, did you add to your euro dollar short? And I'm like, you know, I didn't. I forgot to put in an order last night. I had you know, this is the last week of the kids home, and I failed to put in an order because I was going to actually put in another order at 118.50 to sell a little bit more. I didn't, and so I'm short like right around here. I mean, I've got, and it's not a full size position, but I am short some euro dollars. So, but we do have ADP non-farm, so private sector jobs report in like literally 7 minutes. Yeah. So we're gonna cover that, and you know, here's the thing about the employment reports out of the U.S. We are what many Fed governors see as full employment. Yes. So I would not be surprised if we start missing some of these jobs reports coming up in the coming months. You know, I wouldn't be surprised. So, but at the same time, you look at the dollar, and the dollar has been beat up. I mean, you know, just absolutely raked over the coals. So I've got to assume that the market also sees this as well. I don't think you know, we're looking, but the ADP, we're looking for 187,000 jobs to be created today, somewhere around there, like mid 180s. You know, if we come in less than like, or let's say, you know, 170 or as long as it's not below 150, I think anything above 150, you know, the dollar might see a little bit of weakness. So we might have the euro spike back up towards 118.50, 118.60, but it's not going to be like a, you know, like, oh my God, we're going to hell in a handbasket. If we create only 120, 100 or 100,000 jobs, that may put us at new highs. And so we'll be watching the euro actually during the data release. And this is for you or for you know, Steve, if Steve's here. I don't know if Steve's gotten here yet, but whenever a data release is released in the US, I tend to look at the US dollar, Japanese yen, because it tends to give us the clearest picture as far as dollar response. I'm not always trading the dollar yen. Actually, I won't be trading the dollar yen right now, I don't think. But if I'm looking at the dollar, the response here will be, you know, will be pretty clean. And so on the dollar yen, so I tend to look at the dollar yen during an employment report or you know.
You get the quickest response too.
Yeah, the cleanest. I think it's the cleanest response, because the dollar, the way it reacts against other currencies may be a little different, but because of the way bonds move and yields, and the way that yields affect the dollar yen, tends to be the best mover. So, or the cleanest move. So I can tell you if it's a positive or negative dollar response pretty quickly just by looking at the dollar yen itself. Without staring at anything else, but we'll be looking at that in a few minutes. You know, but going over to the euro dollar, I'm really more focused on the euro right now, on a break below this 117.75. This price here is like you can see like a little wedge breakout, you know, and so this level here will be really important support. If we come back and break through 117.75 at some point, then that's going to be a little bit of a little
put a dent in it. Yeah. You know, something else I noticed, I didn't cover it, Blake, but Apple had blowout earnings, and you mentioned when Microsoft had great earnings and then it was lower. I'm sure Apple's going to be higher, but the S&P's still struggling against that 2480 level. And still look vulnerable to me. You know, one bad day, it almost looks like a flag after the big break we had in the S&P last week. So, you know, all the big earnings, that was the biggest earning report of the season. And if that doesn't take the S&P to new highs, I think that's kind of a danger sign.
Well, yeah, I mean the Dow's gonna open at highs, at record highs this morning. The Nasdaq's obviously a lot stronger because of Apple, and apparently Apple iPad sales have surged, because you know iPad sales have been lagging for a long time, and I understand why. I mean, I've had the Apple iPad Air for like 3 years, and there's no like they do. It's like I don't. There's no reason for me to upgrade. It works perfectly fine.
So that's my signing bonus that you sent me. That was my signing bonus, right? So,
yeah. Those will work. Those will work forever. So, but you know, obviously after a few years, you're getting people like I actually. Mine fell and it put a little crack through it. So at some point I'll probably hand it off to my kids, I guess, and get myself a new one. But I'm not at that point yet. I'm just saying.
I told you not to bring it in the bathroom, buddy.
That might have been it. But anyway, Apple has obviously exceeded expectations, and then we're going into a new cycle with an iPhone too, because personally I'm on the every 2-year cycle, so like I didn't feel the need to get an iPhone 7, but I will get the iPhone 8 when it comes out this fall. So
I think they're going to be over $1,000, like $1,200.
Probably, yeah. They're going to be expensive, but I'm willing to pay. I mean, I and any other Apple user who uses Apple products, that if you're a religious Apple user, you're willing to pay for it because of the quality. It's the quality of the product has always been the standout. Hey, anyway, we got ADP coming up in just in about a minute from right now, so we're going to pay pretty close attention to this. So keep an eye on the euro. I think if it dips back below 118, we start getting in the danger zone. We get below 117.75, and then that might actually mark a near-term high. Remember, we got ISM services data coming out tomorrow. The pound is still pretty bullish here. The Kiwi is really looking weak after last night's employment data. So I think we need to keep an eye on the Kiwi. Also, these Nordic currencies, I'll pull them up after the fact, but the Nordic currencies and like the peso still looks pretty firm.
Nice.
The dollar Canadian's looking pretty good. Thank you. The dollar Canadian's looking pretty good. So stand by.
Okay, here it is.
Okay, that's some strong data right here. I mean, 178, that's much better. Well, it's not better than expected, but it's not, again, you think about what people are expecting, and you can see that the dollar yen is coming in. The dollar yen probably is going to bounce again here. It's going to we're starting to go higher. And the reason why, it's because it's not that bad. people are looking at, and here comes the euros coming in. See, euro spiked up and then it's coming in because the headline number was a little weaker. But again, we're all sitting here going, you know, as long as it's not a horrendous number, it's not a bad number. And it's not. You know, 178,000 jobs. Market was expecting 180,000 jobs, 185,000 jobs. It's not a horrible number. You know, again, when you're near full employment, as long as our jobs picture is not collapsing, you're going to see some, you know, dollar strength come through the market. So it's a really decent number that we came in for ADP. So that's good. It's good for the dollar. I mean, and the dollar is feeling, yeah, it's trying. It's getting a little bit of a bounce. This isn't enough of a data point. Like if we would have created 200,000 jobs, I'd have been like probably selling more euros. But I've already got some short, and like I said, I'm short somewhere around here. My cost averages. We adjust for it when you trade institutional sizes. You adjust your price on a daily basis. It's not like your normal retail client where they constantly roll over, because when we trade pretty large amounts. I mean, when you're trading, you know, if I'm buying, you know, 5 million euro or whatever, that's the banks roll that. They don't roll it over. They charge you on a daily basis pretty aggressively. so it's not, you know, it's like if you're trading retail and you're buying and selling, you know, 10,000 or, you know, 50,000 or 100,000 in currency, the banks will roll it over and it's no big deal. They don't count the, you know, few pennies. But when you do larger amounts, we have to re-input our data every day, and so yeah, it's a pain in the ass. But at the same time, I understand why they do it, because they want to make sure that they're, you know, every day is mark to market for me. So when I say I'm short somewhere around here, that means I shorted the euro yesterday around here, but my prices differ from day to day. So, you know, anyway.
You know, there was one negative aspect to Apple's report that, you know, might have market implications, and that was China was way off. And, you know, that's where they want to build their market. So, you know, a lot of people are convinced that China's okay again, but, you know, off 10% is a pretty big number in China. So I think that may be, if you're looking for any bearish takeaway from the Apple report for the general market, that would be it.
Yeah. You know, I read a brief headline on the Chinese numbers being, you know, rather weak, and I think that's interesting. That's a good point, Dale. It's a great takeaway. So, you know, just real quick, the dollar's not giving us a whole lot of response here. You can see the euro, you know, rallied on a weak number, came back down to on 18.20, and then we're back at, you know, we're just kind of mid-range here. Nothing to do. There's nothing. I don't see anything to do right now, but I want to point out really quick. I'm going to go over just a couple of dollar pairs. Yeah, I wanted to talk about the Nordic currencies. Here's the U.S. dollar, Norwegian krona. Now, I posted on the FX Street website a post about us coming down, retesting this trend line. There's a double confluence here of 161% extension of this move, 261% extension of this move, and we're really finding support here. But what I'm very focused on here over the next day or two is I'm looking at this trend line, because I want to see. You'll notice in here. Let me grab a pen. Okay. You'll notice here we were making lower lows, right? And lower highs. You can see that right there, lower highs. What'll be interesting is if we make a higher low. If we make a higher low and we start breaking back above here, then that's a change in trend, a start of a change in trend. If we start doing this, that means we're rounding that bottom. So keep an eye on there's the Norwegian krona, and crude's been kind of weak, so that'll help that out a little bit. Swedish krona has gotten absolutely destroyed here, and you can see we've got this channel that's been pretty much in play right there. It looks something like, you know, again, I'm roughly drawing here. You can draw something like that, right? Okay, so you know, a move above like this resistance here in the U.S. dollar Swedish krona would be pretty bullish. It's not ready to turn yet, and it hasn't turned yet, but it's something that I'm paying pretty close attention to. Another one is the dollar Canadian. If you guys use ForexAnalytix, you've been very, very well briefed on the U.S. dollar Canadian constantly, because I've been updating it like crazy on here. It's pulling up. Give me 1 second. There we go. I've been keeping you guys up to date on the you know, down channel here, and we've been, you know, just brushing up against it. Now we're slightly above it. So the dollar Canadians try to make a little bit of a turn here, which you know, the dollar Canadian, like Nick said, is her canary in the coal mine, if you will, for the dollar. So if the dollar Canadian's kind of making a turn, you see these Nordic currencies starting to make a turn. You got the U.S. dollar Mexican peso, that thing's approaching channel resistance. You know, these are small little signs that the dollar is trying to base here. I hope the dollar bases and starts to rally a little bit ahead of Friday, because that's what the whole reason why I started buying dollars here is, you know, I wanted the data to start improving. And like I said, the ADP non-farm was not horrible, but it also wasn't a beat either. So, you know, I don't know if we're gonna have to wait till tomorrow's ISM. Yeah, hey, Stel.
Hi, I just wanted to add as well, the revisions on last month's ADP was pretty big, you know, from 158 to 190, I think.
Yeah, you know, Brian said that
so
too.
Just something.
Yeah, thank you. Brian said, yeah, ADP was revised up 33,000 for June. So I mean, that's not bad. I mean, you know, it's not horrible. And you know, Stelios, I know you're on holiday right now, and you're actually tuning in while you're on your vacation. But you know, I don't know if you heard what I said about the you know, the full employment. You know, as we report employment numbers, I think everybody's expecting us really employment pictures start to sour a little bit. But the fact that it's not horrible is, I would say, not bad.
No, I agree with you. And, you know, there's always going to be some unemployment, you know, due to frictional unemployment. But the thing we have to remember is that unemployment in the US is low as a percentage because of the participation rate, which, I mean, it's a factor of that. It's not because of that. But participation rate is at like 40-year low. So I think you are right. Unemployment is good. It's looking good. It's not, you know, perfect. It's not fantastic, but it really is good. So you're right. You know, it's gonna take a lot to see unemployment, you know, take a hit from here. Yeah, you know, I agree with you. It's, you know, the picture is not looking bad at all at the moment. So
yeah, it really isn't. I mean, if you look at you look at employment. This is the ADP number, by the way, and we can pull up non-farm, and it's going to look pretty similar, though. I don't have to, you know, beat it up a couple of different ways. I mean, if you look at employment, how steady it's been, and you're right. People always come back at me and they say, oh, but Blake, you know, how about the participation rate? And you know, I think the employment in the U.S. is actually horrible.
Yeah, I mean, you know, to me, that chart looks like very steady employment at Home Depot, McDonald's, and Burger King.
Well, that's the thing. It's the quality of work that you're saying, and the quality of work, I think, is very poor. If you think about the underlying health of the U.S. economy, it's, again, this is all a product of an artificial economy, or an artificially inflated economy, where the Fed is pumped in, and not just the Fed, but every central bank is pumped in, you know, ridiculous amounts of liquidity into the capital markets to get your trickle down effect to where the wealthy are more wealthy, and the you know, and it segregates the two class. I mean, we could go into conversation after conversation about what has happened here, but the employment picture is steady on paper, and if you look at the numbers that we're seeing here, just from a jobs standpoint, and the number of jobs and people that are finding work, they're finding work. But I think if you peel back the layers of actual U.S. employment, the picture is probably not as rosy as it looks on paper, and that's why I think that, you know, you're right. It's like the quality of jobs are the jobs that are being, you know, met. But again, at the same time, it's like you have like the participation rates really low, because you have a lot of people that are they've given up over the years. And it's amazing, because we watch the real estate market pretty closely here in Phoenix, and the reason why we do that is it's a hot market. It's not it's a market that is a good indicator of, you know, the real estate market. It's a nice leading indicator of the real estate market around the country, if you will. Yeah. Nationally, yeah. There's the trend in the homes here in the Phoenix metro area. There's a lot of multifamily properties, because the trends have been for the last several years is, you know, you got two generations of families living together under the same roof, and that's not uncommon, because you have a lot of people that, you know, if you were a baby boomer and you're like, oh, I wasn't ready to retire, but I got let go of my job when I was, you know, in my late 50s, and I haven't been able to find work, but now I'm living with my daughter, and you know, there's a lot of that going around, and those same people are the people that are like, okay, well, you know, I should be retired, but, you know, I'm also bored, and I can't find a good job, you know, of being, you know, maybe a computer programmer like I used to be. So now I'm, you know, I'm using an example, like I'm a greeter at a restaurant, or I'm a security guard, or I'm a, you know, they're picking up odd end jobs, which, you know, like I said, I think if you actually peeled back the employment picture, it wouldn't be as pretty as it seems here. But anyway, that's a long conversation. It's not even a conversation.
Hey, Blake, before you go, I usually don't look at the note, but can you pull up that note chart that you had on before, USD note, and you drew a path of what could happen? I just want to offer a potential alternate USD.
Oh yeah. Hold on one second. Sorry,
that's okay.
I actually got rid of what I was doing here. Yeah, here's the note.
Okay, so the other potential is one more shot down to take out the previous low for a possible 3 drive, and then if it reverses, that's also, you know, that's also a potential buy area. Now sometimes they could go underneath that line and have an overthrow or underthrow, but that's a pretty classic potential 3 drive setting up. Just wanted to.
Yeah, you know, I could see that. And again, when you're skating across a trend line here, like this, see this trend line, this is very significant in my opinion. But when you're skating across this trend line here, it you know, to hit a new low would not be surprising to me. It wouldn't. Yeah. It would not be a shocker.
It's a potential reversal formation. That's okay. Thank you, buddy.
Yeah, no problem. And also, I just wanted to mention that, you know, having these conversations on summer days, like a lot of people I know are now taking they're taking the rest of August off, and most people aren't even coming back until Labor Day. No. Jackson Hole, you know, which will be August 19th or no, August 23rd.
Okay.
It's this week. Wait, hold on. August 23rd, 24th, 25th. So a lot of people are you know, are just, you know, taking some time off, and so to have these types of conversations while the market's just not doing anything, I mean, it's okay, because, you know, you look at the charts and you're like, well, you know, there's nothing to do right now. There's absolutely nothing to do. Steve Steve, are you here?
Yes, I am.
Hey, Steve.
Good morning.
Hey, good morning. One of the things before Steve comes on, I wanted to mention is, you know, the U.S. dollar Japanese yen has found some support overnight. We found some support at the 786 retracement, and because, you know, the Nasdaq was, was bid up, and with Apple earnings, and you could see here that yesterday at the end of the day, we're like the dollar yen thwarted the 110 level. By bouncing, which is important since it was the 786 retracement. Right here is a 78% retracement, and we bounced from there and said, you know, it's too early to call, but the dollar firming elsewhere, the dollar yen may be ready for a bounce as well. However, the 111 level is tough, recent congestion area. So I mean, we're back up towards 111 as you know anticipated last night. But this is this downtrend line is going to be a pretty big deal, I think, for the dollar yen. So keep an eye on the dollar yen as we approach this 111 level. I mean, because with equities moving higher, we could stage a bit of a move a little bit later. So just I think we should keep an eye on it. I think it's quite possible we can make our way above 111 today. So anyways,
I'm with you.
Yeah,
we already saw yesterday that it's, if you go on the daily, Blake, you'll see that it's not only the 78.6, but it can also be measured as, if you go on a daily chart, it can also be measured as a triangle support, because if you see that trend line exactly. If you ignore that one single, exactly. So, you know, there is a second way to draw this line, and it's that way. So in this case, you even have a confluence there, and that's what I mentioned yesterday. So I said that people should be very careful with being short the USD yen, because you know there is a chance that you know this is going to be a rebound area. And you know, yesterday's hammer, today we see some continuation. In general, it seems that we might be building here a morning star formation on the daily chart, on the daily chart. So you know, why not another push higher?
Nice heads up for our community, Steve, on that yesterday. Thank you.
Yeah, that's why we're here. I mean, you know, to share.
Right, to share and you know, hopefully you guys, you know, it's to share ideas that can help you avoid, like, you know, getting yourself in a pickle too. You know, if you can get a nice little heads up like that, that's what it's all about. So anyway, well, Steve, I'm going to pass it over to you guys, and I hope you guys have a great trading session. Just remember, it's pretty choppy here, and I'm not 100% sold that the dollar's ready to bounce and ready to come back yet, but I think we're starting to see some signs of it, and you know, so I'll be watching closely to see how the euro acts at highs, or if it comes back down to 118, how it acts down there. So, but it's all you.
Okay. Thank you, Blake.
Right. Thanks,
Hey,
Steve. Thanks, Dale. Thanks, Delios.
Okay. Good morning, everybody. Let's see what we have. I know that we didn't even have the time to cover some of the questions yesterday. By the way, now that I think about it, I think Greg is gonna be here today at some point. Let me verify. Okay, so first of all, I know people want to see the euro USD constantly, but I'm gonna go ahead and have a look at the USD Swissy again. You know, this one broke above this channel. We had 2 days of a consolidation, mostly a triangle, if you see. And then we seem to be moving higher again. Of course, once again, that's a product of another move higher from the Euro Swiss, because the Euro Swiss, as I said, I doubt it's going to stop moving higher. It's one of those days that we've only seen lately that we have a higher Euro USD, and at the same time, we have a higher USD Swiss. Obviously, if the Euro USD also actually turns lower, because we still haven't seen a turn. I mean, even today, so far, we've registered a new high. And if you see almost on a daily basis, I mean, some days we have like a 1 day break, but we've been registering new highs since we actually broke above the 114.50 level. We've been posting a new high every second day, and this is not an exception. Okay, so there is no real signal yet. I mean, we have this very nice resistance level on the, if you see on the long term view, you can see the level that Blake is seeing, and yes, it seems to be holding for now. But we don't have some solid reversal yet in our hands. But if we get that, probably USD Swiss is going to fly. So if you're looking for the reversal, I'll repeat once again that you really need to play it through the USD Swiss. Now, on the other hand, something we didn't cover yesterday, we had a move in the bunds. Okay, we were looking for a breakdown at the bunds when we saw this candle and this resistance here, and as it seems, this didn't prove enough because we held on a closing basis the channel. Luca is asking for it, and we had another thrust higher yesterday and another retest of the channel resistance. That was also the 50%. So as long as
corrective, doesn't it, Steve?
Yes. As long as this channel holds and we remain below the 61.8, that's exactly what I wrote yesterday. The main interpretation can still be that this is a corrective bounce. Okay, so still this view has not been invalidated. Obviously, we don't want to see a continuation higher, especially with candles like the one we got yesterday. But yes, this can just prove to be a more complex correction. I wouldn't want to see a close below the 61.8 and definitely not above, and definitely not above the area I've marked here, which is just below 164, because then it means that something else is in play. And that's not going to be like entirely surprising, because if you see, we've spent a big amount of time being more or less range bound. I mean, this is like a big triangle, a little bit descending, obviously, but even within it, we've seen like violent moves in both directions, like this move lower, that move higher, this move lower, that move higher, this move lower, and we might end up having a triangle within a triangle. Who knows? I mean, it's obvious that the market at the moment is is in a long-term consolidation. But given the prior move, yes, I still remain of the opinion that we should at least see another leg lower towards the 160 area, or even lower, towards this blue trend line. That's the view on the bond, Luca. Euro pound, yes, Euro pound. Conrad wants to know about Euro pound. Let's have a look at it. Okay, first of all, I have to tell you that what I don't like about the Euro pound is, first of all, the fact that the pound seems to be in a resistance, on top of a resistance zone, and even if it breaches this, we have the 161.8, and this price action that we've been seeing since June, it's not impulsive. Just look at it, right? It's quite a lot overlapping. Yes, we keep seeing higher highs, and that's obviously, one of the elements you want to see in an uptrend. But on the other hand, there's nothing impulsive with this move. I mean, it's not strong. It doesn't have momentum. It doesn't penetrate levels. It doesn't slash through them like butter. And even if you look at the Euro pound, I mean, this recent move, it's like one big consolidation. And if you see at the daily closes, I mean, the daily closes since the 25th are like within a few pips from each other, right? I mean, if you ignore the wicks and you just see where the pair closes, I mean, it still doesn't tell me that, this thing is about to break down. I believe that it would when I saw this move, but having seen this, yes, of course, this this is a possibility if we see some kind of an acceleration. But to be honest, I've started believing that, you know, it wants to move higher once again. So, you know, I'm very cautious. I've already, you know, closed this position that I had. It didn't trigger my stop loss, but I closed it with a little bit of a loss, because this does not inspire me. I mean, you know, I give at least 50% chance of another move higher, and then we see what happens from there. So, you know, I don't have a strong opinion on the euro pound. I just know that it's not playing ball. So, you know, it's one of the markets that you currently probably don't want to get involved until you see it come back to life. And, you know, that doesn't seem to be the case at the moment. Look, maybe looking too far ahead, but I'm looking for a repeat of last year's pattern. Let's have a look at what Luca's seeing. I'm guessing it's about the Bund. Yes. Okay. Let's.
Steve, I have to say on your euro pound out, it's a great example of Pinkertism, that the difference between pros and amateurs are pros know how to lose, so they have money left to be right with. And you know, so really, you know, everyone should be wrong in that way, the way you were wrong in euro pound, and they'll be a pro. So congratulations.
Yeah, thank you. You know, I try not to have very strong opinions. I mean, when the market tells me that something, you know,
that's a sign of a pro, Steve. You didn't fight it.
You don't fight it. You don't fight it. You just, you know, you just go along with it.
You're also a living example of W.D. Gann. If you don't learn how to change your mind, you won't have any change left. So, you know, very good. I think it's good that we talk about our losses in here and how we manage the risk. It's much more important than, oh, yeah, you know, we're right for 200 pips there, 200 pips there, because, you know, really the skill is knowing how to be wrong.
Yeah, that's one of the reasons that, you know, I stopped trading quite fast using fundamentals, because the problem with fundamentals is that if you stick to, you know, to the belief that the market is going to follow sooner or later your fundamental thesis, the problem is that you stay too long on a losing trade. And, you know, a fundamental thesis can even take years, and I'm not exaggerating, years to actually manifest. Yeah, so there is absolutely no chance that you can trade with fundamentals unless you have a huge portfolio and, you know, a very very patient you know, mood or clients or whatever. It depends on if you trade for yourself or if you trade for other people. So,
you know, that's a great point about having deep pockets, because I know a lot of our community, Steve, use you know, COT reports. You know, it gives you, you know, you use DST, but a lot of people want to know what the commercials are doing.
We use both of them, actually, both COTs and DSI, yes.
Yeah, and the commercials, you know, you look for the commercials to be big in one direction or the other, and they're always early, and they can afford to be early. So, you know, you can't just take a trade based on COT, because retail traders are bullish and commercials are bearish, because they have the time and the finances to ride out, you know, things if they're early. And
exactly, and you know, I've experienced that years ago in action. I mean, you know, in the fund that I'm involved with, you know, the guy that had the fund is a guy that trades a lot with his fundamental thesis, but he has a very big portfolio, and he really likes carry trades. He really likes exotic currencies like the ruble, etc., like the Indian rupee, etc. Needless to say that when the ruble got massacred, he at some point he ended up being like 3 million euros out of the money, and you know, that wasn't an easy you know, phase to go through.
No.
Not at all. And you know, he had the mental capacity to stick with it, and he actually ended up making that amount after being, you know, the equivalent amount out of the money. But I have to tell you that even him, you know, that, you know, he could even afford losing that money. These were not some easy days. I mean, he wasn't in a good mood, let's say.
Yeah, I would say that. Yeah, if you can still smile with that going on, you're definitely a warrior. Pure Class is asking about CAD Yen. May I suggest, Pure Class, that you spend $1 to see Nick's view on it, her harmonic work on CAD Yen. Click the trial for $1. And I think once you see Nick's work, you're going to want to know what she's thinking a lot, as well as Greg and Blake. So we don't cover everything. If you want to, go ahead, Steve, but it is a pattern in play here. So what are you thinking?
I'm thinking that...
go ahead.
I'm thinking that CAD Yen is...
Stop it.
Has a big chance of actually catching people off guard, because I even see an ascending wedge, which somebody can see that it's breaking down. First of all, it played ball very nicely with what we expected. I mean, we drew this back here, if you remember. It followed the price action we were expecting exactly. It gave us one more high, then one more high. That's all we had drawn back then, but we can now delete. But I'm going to tell you something.
Hey guys.
Hey, Greg is here.
Greg is here, and Greg, that's a perfect timing. I'm of the feeling that CAD Yen can even produce one more high. I don't know what you think, Greg.
Yes, I can share my screen if you want.
Yeah. So I see the you know, why somebody would expect that a break below here would take us lower. But I can also see a potential, I don't know how you read it, Greg, but I can also see a potential flat as a fourth and perhaps a fifth missing. You want me to give
a regular ABC. How about that for a novice? Yes.
Yes, I would be looking for a pullback back to 87.
Okay.
Yes. Okay.
Okay.
So as a wave 4, so you also believe that there is another high coming?
Yeah.
Yes. Okay.
Oh,
Hey, can you see the chart?
Yes, got it.
Yes.
Greg.
Okay, so actually what I think we are going slightly higher is, actually that's a cross, and you know that crosses can stay sideways for a very long time because a lot of moves will be depend on US dollar value. So I'm not surprised to see CAD Yen in a very big range, and I'm looking prices now to trading higher towards the upper side of the range, and ideally that's a wave E. So wave E should be made by 3 waves. So I'm tracking now A, B, and wave C to the upside.
Greg, I know you weren't here, but let me tell you something else that you might want to consider. Have you seen the huge inverted head and shoulders? I said that, I think yesterday, the day before yesterday, this huge inverted head and shoulders on the CAD Yen, which also points to a wave E, but perhaps wave E even extended higher. Yep, now you see it.
Side of the range. Yes, I know what you mean.
With a target of one, yes, with a target of 103 actually, yes.
Okay, so 103. Okay, I would, because that's a psychological level, I would say 100. Okay, it's
sure.
Also,
but regardless,
yes, but old school projections of head and shoulders, yes, suggest 103, I believe.
But even 103, since it's lower than your C wave, wouldn't invalidate the A, B, C, D, E, correct?
Correct, because invalidation level is at
would be above, yes, above 106, whatever the hell that is, yes. Okay.
So the key is here now that we are probably going to see higher levels for wave C, especially as you pointed out, because of head and shoulders pattern. So now the idea is that we are just in another pullback. It can be wave 4, okay, of this lesser degree of wave C, or it can be even, if I adjust the wave count, okay, maybe we are still in an extended wave 3. Okay, so the idea is that I think that we are going to see higher levels after 3 waves of a setback.
So perhaps you mean that from the previous low that you've marked as the end of B, perhaps we've had a 1, a 2, then a 1 of wave 3, and now we might be even just finishing the third wave of the third wave as an alternative count.
Yes, if you focus now on the black letters, yes. 1, 2, 3, 4, and then you go higher for red wave 2.
And then that's the end of 3, then you have a 4, then you have another high. Okay, yeah.
Yes. But the idea is for short-term traders is that they should stay with this current uptrend, okay, after this pullback, no matter if it's black wave 4 or red wave 4, both wave counts suggest that we should continue higher. Also, keep in mind that wave C will normally be similar to wave A, okay, and we just spiked for a few pips here above wave A, so I think there is room for more upside. Probably a lot of stop orders were triggered here, and that's why we are reversing, and most likely we will see a 3-wave setback as a set for a wave 4. Now if we take 38.2% for wave 4, and let me check where we get there, 86.30. Okay, sometimes wave 4 could retrace also only 23.6.
Yeah, be more shallow, yeah.
Yes, but maybe in a triangle formation, but for triangle formation, that's still too soon, I believe. So I would watch out for maybe for 87 as a set, and then look for a move to the upside. But you have to see a 3-wave structure on a lower time frame chart before this uptrend may continue, because we know that corrections are made by 3 waves.
So wait a second. Let me give you an alternative idea and tell me if that's if that's a possibility. What if the end of 3 or whatever it is was a little bit more to the back, and this is an irregular ABC? You know what I mean? Yeah. So if that is there,
that's also definitely possible. But so far, let me go to smaller time frame. But wave C should then be impulsive. Okay, this leg should then be impulsive if you think that this could be maybe a flat, but that's not. So I think that maybe then this could transform maybe into some other combination or complex correction. But the key here that we are in a temporary pause here of a pullback, but what type of a pullback this will be? What type
we need more price action to say, yeah.
Yes, it's still too soon, definitely. But always, I'm trying to focus on 3-wave structures because this will assume more.
By the way, Ali is asking for the DAX. By the way, yesterday, I mean it's very fresh. We posted on our blog Gregor's post about the DAX. I also spoke about it. Gregor, before you made that post, I spoke about it like 2-3 days ago, and I said that I like the DAX higher because I see a 3-wave correction, a very clean 3-wave correction, and we're already seeing that. And Gregor has written a nice post about how the DAX might recouple, might re-engage the risk on of the US stock market. So I really suggest you go have a look at it. But Gregor, you can go ahead and show briefly what you see in the DAX.
Yes, actually, what I like about the price action from the last 24 hours that we perfectly bounced from these support levels, peak support levels, and it looks like that we have an impulsive upward reaction, and this reaction actually came from after filling this gap.
This gap, yeah.
Make this bigger. Okay, so after this gap was filled, actually on a point, we are now going higher. So I think that there is more upside coming on DAX. But firstly, I would be looking only for minimum expectations, which means towards the upper side of this still downtrend channel. But definitely this downtrend channel should be taken out to take us back to new all-time highs. Okay, so for short-term traders, definitely tradable low seems to be here in place, at least for a rally above this former wave 4, and then, as I said, towards the upper channel resistance line.
Okay. Our friend here, V, is asking if you want to have a look at the Aussie USD.
Aussie dollar, okay, sure.
Yes.
Aussie dollar is actually setting up a very nice pullback here. Now on a daily chart, if we make a quick overview, we are tracking a big free wave rally, and normally wave 4 will retrace back to the area of a former wave 4, which is right here. Okay, so I'm expecting this to be
another push higher. Yep.
So I'm staying bullish here on Aussie and expecting a retracement towards this 8160 level, and it looks like that we may see a new leg higher after a free wave of retracement, which is now unfolding on a 4-hour chart back to this support area of a lower wave 4. Okay, so
yeah, that's why I said yesterday as well when they asked me, I said that I'm not so sold yet that the pullback in the Aussie and the Kiwi are actually reversals. That's what I said as well. That
yes.
You know, yeah.
It's probably just a correction that will take us back.
Yeah, I'm afraid of the same thing as well.
Yes, and also we have a very nice 38.2%, which comes in exactly at these levels of a former wave 4, former swing support.
So it's a next confluence.
Yes, and wave C projection. Practice. Wave C projection is
a little bit higher. Yeah,
79, but then 161.8 extension is at 78.20. So maybe this should be a nice area of support for
between 78 and 79. Yeah.
So 80 to 150 range, I would be looking for a bounce. And since this market is now going slow into the week end till non-farm payrolls report, probably we may be consolidating and then get a bounce, maybe already turn up on Friday, maybe next week. But definitely, I think this is just a pause with an uptrend still.
Okay. Do you also want to have a look at, let me see which Euro cross we got asked for. Let me find it. I think it was Euro Kiwi. Yes, Jess wants to know about the Euro Kiwi. And Jess, I'm going to give you my opinion as well. Let's see first what Grega says in the Euro Kiwi. And I'll tell you, we already, okay.
Okay. So actually what I see here is that we are turning to the upside since the market made the 3 waves of decline from this 2015 peak. And we broke this impulsively higher above this downtrend channel. So I think that we are going to see higher levels. I'm not so confident about this long-term call for another strong rally here for wave C, but based on minimum expectations, I would be looking for these wave B levels to be triggered. And since this was only first leg of recovery, and since my expectations would be for a recovery to be in minimum 3 waves, I definitely expect more upside to come into this wave C. But the question is if this wave B is already finished.
I think, Grega, that, I mean, from a basic technical standpoint, I think that it might be finished because I see a triangle break. So, you know, I have it on my chart as a triangle, this recent consolidation in the Euro Kiwi.
Yes, but for me, that's a little bit too impulsive. While this recovery.
Yeah, I understand what you mean. I understand what you mean.
So, actually, I'm looking this to be maybe some fake breakout or above this previous swing high, and I'm not really sure if this pair can stay bullish for the whole week. But if on Friday we will see prices still trading at these levels or maybe even higher, then yes, we are.
Yeah, when we broke above the broke above the triangle, I wrote that I have a target that's at 160.70. That at least I think we're going to reach that area, and then I want to see how that area is going to react before making judgment of if we're headed to new highs directly or not. That's my view. So it's not much different than what you see there.
Yes, but the key is here that on the longer term, we should continue higher after completion of wave B. So I would be looking for much higher levels if we close on a daily basis above wave A. But until then, I would be expecting.
You would be expecting another drop lower. Okay, that's interesting. Let's see.
Yes.
And what's the alternative count? If we straight ahead bridge through that area, then what is your alternative count?
My alternative count would be just very simple. I would move wave B here and would be looking this blue wave C to be wave 3 of wave C.
Got it. And then you would expect a 5-wave move to complete the ABC, the red ABC. Okay.
Yes, but please hear that if you think that we are going higher, you definitely need to see an extension from current levels because you want to see wave 3 to be one of the strongest. So this week you should get confirmation either we are going to see break above this previous swing high or we are still in a correction.
Okay.
So
okay. Nice.
We'll get an answer very soon.
Thank you, Grega. It was great hearing you. And I have to tell you, Grega, having your work at my fingertips is a big edge whenever I want it, and also know that if your views change, that I'm going to get an alert. So everyone, thank Grega. He's the wizard of waves. And thank you so much for your looks today, buddy. Always good to see you in here.
You're welcome. Thank you.
Okay, and I'm going to start the interview. Jawan, I'm going to make you a panelist because you said you're not going to have charts, but you want to talk about the dollar. So I'll be showing my screen while this is going on and waiting to hear your voice. Hi, Jawad, how are you? Okay, we're getting kind of a crummy sound. Can you hear me okay? Yeah, you're breaking up. Yeah, it's not going to work unless you can make it. See?
He's lagging a lot.
Yeah, I've never heard it this bad. Why don't you try logging out and coming back in, and we'll give it one more shot. Maybe that'll work. Because yeah, it sounds like techno to me, Steve. How about you? Techno rock? The robot? Anyway, you sound like a robot, Jawad. I was really looking forward to this interview. We'll most likely have to reschedule it because of technical difficulties. So,
except if there is something up with his
mic?
I don't know, with his network. I mean, for he's on a Wi-Fi. If he wants to check, you know, if the distance is an issue or the speed or if he can connect via an Ethernet, but you know, he seems.
Can you try and say something again, Jawad? See if it's any better.
Wait, I think he's trying to connect with by phone now.
Okay.
I think so. If he does that, it's going to be absolutely fine.
It sounded like that, V.
V. He asked if he's still on a dial-up connection. I really remember having dial-up connections and needing 20 minutes to download a single song.
I remember that sound.
These were the days, weren't they?
Yeah.
I think he's back through. Yep. Now we can hear you.
Hi, Jawad. Nice to meet you.
Yeah, it's perfect actually. We can hear you perfectly.
Yeah, nice to hear you clearly, and nice to meet you.
Absolute pleasure. Thanks for having me.
You're very welcome. So I have your website up here, Straight Reflections. So this is where you are. I'd have an interest, and I read a little bit about you on your website, and you sound like a real Renaissance man. And I always say trading is what we do, it's not who we are. And I've noticed that's your story as well. Can you tell us about your early days looking at the markets and how you got involved in managing money and becoming a trader, analyst, market commentator?
Sure. So I've had a very unconventional background. I'm from Pakistan, born and raised in Dubai, spent half my adult life in Canada. So very multicultural in background. I went to university in Canada, and that's where I began my career. First job out of university, I was actually a bank teller. No one aspires to be a bank teller, but frankly, that was the best thing that could have happened to me at that time, as it allowed me within a bank to figure out what the different divisions of a bank does. And through that, very quickly realized that actually asset management is what sounded most interesting to me. So as soon as I figured that out, I was 20 years old at that time. I started reading as much as I could, Market Wizards from Jack Schrager, Stephen Drobny's remarkable books, as well as many others, to learn as much as I could. And I did my CFA examination, did my CMT examination, had a lot of senior traders and portfolio managers from the Toronto community sort of mentor me or spend time with me to improve my skill set. And then I moved back to the Middle East about 10 years ago, and I was primarily a proprietary trader across global markets. And then 4 years ago, I left to begin Trade Reflections, which is basically a global macro research and trading advisory. And that's basically a summary of whatever I've learned up to this point, what I continue to learn, and putting that forward for our clients in terms of structured thought around major investment themes and actionable trader ideas across multiple assets. So focusing on stocks, bonds, currencies, and commodities. So intermarket analysis is very important to us. Thinking deeply on multiple time horizons is important to us. We're not short-term traders. We like to live in the future and think about what the world would look like 6 to 18 months from now. So we bet on big moves on the back of that.
Okay. Yeah, kind of like Wayne Gretzky. He skates to where the puck is going to be, not where the puck is. So interesting journey that you've had. And yesterday on Twitter, you told me you really wanted to delve into what's happening with the US dollar. And I posed this question to several guests that I've had. You know, we peaked at 104, and, you know, it was an ongoing bull market for quite some time. And a lot of people were surprised by the decline in the dollar. You know, I humbly say we weren't. But I'm curious if you view this as a secular change or a cyclical change in the direction of the dollar.
So the way we think about the dollar, or any asset class for that matter, is in terms of phases. So I think I could identify for you 3 phases within the equity market, 3 phases within the fixed income market, and similarly 3 phases within the dollar bull market so far. And just from a background perspective, I think it's important to understand where we are in that cycle. So I think the dollar reached a peak against major currencies in 1985 and fell around 52% to a major low in August 2011, which ironically coincided with the S&P rating downgrade. So the first stage of the dollar bull run since then simply corrected the negative sentiment and historic undervaluation. So from 2011 for the next year and a bit, that was the first stage. By mid-2014, then you've seen the Fed's divergent monetary policy, interest rate differentials, and growth trajectories favored the U.S. over other countries. And as this became the key investment theme for global investors, we saw the largest dollar rally on an annual basis in 30 years. And this was the second stage. And if you remember, everybody was talking about monetary divergence, and the dollar was just going to fly to the moon.
Yes, we were going to be, you know, sub-parity in the euro, et cetera, et cetera.
Exactly. And this brings us to December 2016, and then you had the Trump win, and suddenly markets repricing as well. So these are the first 2 phases, and we argued that for the third phase, we basically need a new trigger or a new narrative for the uptrend, because the dollar is by now expensive by any measure, and because the Fed was the primary driver of the second phase, it can't be the driver for the third phase. So you need to have a new trigger. And if you remember, again, Dale, towards the end of the last year, a lot of people were seeing a stronger dollar as the clearest investment implication of a Trump win, because they were comparing back to Reagan's environment in the 1980s,
Right.
and how you were going to have tight monetary policy and loose fiscal policy, and the dollar would just really soar in that environment. We took a contrary bet, I guess, much like yourself, coming to the same conclusion from a different angle. We felt the comparison with Reagan is not fair, because unlike Reagan at that time, I don't think Trump inspires a lot of confidence of global investors. And we were hesitant to believe that the U.S. could continue to attract the sort of portfolio inflows that were seen in the 80s, which led to the supercharged dollar bull market. So we actually argued that the dollar no longer looks irresistible to foreigners with Trump as president. And so technically speaking, around that same time, the DXY went to 104, just a little bit over what for us was a very important technical level, which was the 61.8 fib retracement of the entire 2002 to 2008 decline.
This
so
whole wave.
This
whole wave.
Yeah.
And right here, 61.8. Okay.
So our work suggested that when you hit such a significant level, you're pretty much into a consolidation correction phase for the next 6 to 9 months. So technically, we felt we were entering a consolidation correction phase for the next 6 to 9 months. But as we're mostly fundamental-oriented investors, we started thinking about what could result in a deepening of the dollar decline based on extremely crowded consensus positioning in long positions against in the dollar. So entering this year, we were short the US dollar in our portfolio around 95% of NAV. It's extremely, extremely short, and we were long euro, the British pound, and the yen in most cases. And just to review the thesis, because I think it's important to reflect on what the outlook was in January and where we stand today, because that will determine where we could end up, let's say, 6 months from now.
Yeah,
So
it's flipped 180 degrees sentiment, hasn't it?
Sentiment for sure, but I think what's also but I think what's also important is, apart from sentiment, which I think is an important tool, fundamentally, frankly, there's been major shifts that I think are less often discussed. So let me just summarize for you what was our bet at the beginning of the year, and then how the fundamentals stack up today. So we were basically aggressively short the US dollar all year, betting on the following 5 forces. Number one, we were expecting, unlike the divergence that we saw in mid-2014, we were actually expecting a convergence of monetary policy among the world's major central banks. Basically, you had a very well-articulated and predicted path of future Fed policy versus a sharp hawkish turn in other central banks' language and actions, which would put the dollar rally at risk. And then secondly, if you remember, expectations of President Trump passing his pro-growth agenda through Congress were running well above what we thought was practically possible. And we felt that once the realities of the American governing system set in and the faith placed in President Trump sort of subsides, so should the strength in the dollar. Because he's extremely
David Stockman was all over that view, the former budget director for Reagan. He said they wouldn't be able to get anything done. Yeah. Go ahead, Jawad. Interesting.
So that was another catalyst. Third catalyst for us, we were extremely convinced in our view that Europe will remain unified and that the populist forces will be defeated. So we felt if we get forces moving towards EU integration, and if Le Pen loses, then frankly this breakup risk premium that was embedded in the price of the euro for so many years would simply vanish. And you'd actually see money moving away from the US towards Europe. And that will basically help the euro rise, and by influence result in a weaker dollar. Alongside that, we were optimistic about global growth. We saw more synchronization in economic cycles, and that's usually supportive for EM carry trades. And again, that would mean dollar would be weaker, and you'd see risk-taking increase and emerging market currencies rally. Again, it's just funny how markets work, right? You've been in the business a long time to know that Trump railed on Mexico throughout his election campaign, and the USD MXN peaked around the time that he was inaugurated. And since then, we've seen Mexico strengthen. So that was the third reason, basically. We felt the defeat of populist forces in important European elections and better growth would lead to euro rallying and EM carry trades making them come back. And then fourth is something you alluded to, which is the bullish sentiment on the dollar. If you remember the Economist magazine in December with the greenback and that strongman sort of a suit, which was just showing how the dollar is going to remain strong here on forward. And then we combined that with extremely crowded long positioning at stretched valuations. And from our conversations with a lot of different hedge fund managers, it was pretty much the de facto Trump position for them. And we felt with speculators at the same time amassing a record number of short euro positions, again, the risk was limited to bet against the dollar. You couldn't stretch any further. And like I said, lastly, from a technical standpoint, we just felt the Fibonacci retracement would be a significant barrier in the short term to surpass. So again, it would help us cap our risk. So those were the 5 forces back then. Since then, we've seen, the trade weighted basically closed down 7 months in a row, sentiment at rock bottom. And let me just see or observe for you some of the fundamentals today as they are shifting. So a lot of people have belatedly begun shorting the US dollar because they just did not expect it to be so weak. And I think a lot of money has chased European assets after May when the Fed actually lost. And a lot of macro managers, and I think this is probably interesting for your listeners and your viewers, a lot of macro managers that struggled in first half struggled because they were caught wrong-footed on consensus trades. And a lot of them are moving into Europe and the big European trade team belatedly to make up for that lost performance, which is why you've seen this relentless bid in the euro. It just barely corrects and just keeps moving higher and higher. And we've seen that over the last few weeks. So now, let me put this forward for you, because right now, as of Friday, we actually started shorting the euro. We've been long USD CHF for about a month now, so we're up about 1% on our USD CHF position long, and we shorted the euro on Friday, so we're down about 60-70 basis points on that. But let me just explain why we've flipped now from being extremely short US dollar to now gradually becoming bullish USD on the margin.
Okay.
And I would say consider the following, right? So from a Fed policy perspective, it seems investors want to interpret the Fed dovishly and the ECB much more hawkishly, with the market pricing only about 60 basis points between now and the next 24 months of tightening, which seems pretty dovish to us, unnecessarily so, frankly, because we think the Fed will deliver much more tightening over this period than what the market is currently pricing. I mean, the U.S. economy, again, people keep worrying about a recession, but we frankly think the U.S. economy is in a much more durable expansion. And the economic surprise index is most likely to be rising from here over the intermediate term. Meanwhile, if you look at Europe, it's still well behind the U.S. in its cyclical recovery. And any rerun of political risks with the Italian elections in 2018, for example, will force the ECB to remain accommodative, much more so than what people currently expect. Let's not forget the euro is already 8% stronger than what the ECB staff assumed just last month. And on a trade-weighted basis, it's within 3% of all-time highs. They just simply can't afford such a strong euro. And whereas, let's realize that the unemployment rate is falling in Europe, it is still 2% above pre-crisis lows, and inflation is still squarely below the 2% target. So given sluggish wage growth and across most of the region, and the lag effects of the stronger euro that we're seeing, inflation pressures will again dampen going forward. So from that perspective, relative even central bank balance sheets with the Fed unwinding starting probably in October would argue for a higher dollar versus the euro.
So let me just interject for a second here, Jawad. So are you looking at this when euro peaks for this just to be a corrective move of the advance we had from 103? Or do you think that the dollar could recover all of its losses? So in other words, is this a trade, or is this your view that we could end up eventually within your longer term time horizons trade above 104 in the Dixie again?
So sometimes you don't have all the answers, right? And I think
great. You know what? That was a great answer.
So the way we think about it right now, we are open-minded. So we are open-minded to both interpretations. So we are open-minded to believing the dollar bull market can continue. And I think we've got fundamental reasons that I could argue for that to be the case. Because I think technically we're neutral. I don't think we can make a technical argument for the fact that the dollar bull market is over. And I can also make technical arguments that there's significant more upside left. So technically, I'm not getting any answers on a longer-term time frame. Fundamentally, though, I think there are answers to be had. And I think, like I said, you need a new narrative for the third phase of the dollar bull market. So based on our thinking, what will be that narrative? Two come to mind. One is rising protectionism, because rising protectionism is dollar bullish. So if we begin to see the U.S.-China tensions increase, and the U.S. And the White House focus more intensely on the trade deficit and wanting to close that, then that would argue that the dollar bull market will continue and we'll see new highs. Short term, what have we seen? Actually, them not moving in that direction, because the much debated border adjustment tax has actually been thrown out the door. So that would have been the immediate catalyst for you to see a very sharp dollar in the rally. So we've taken that off the table. But that doesn't mean they can't have protectionist measures in the future. It just seems unlikely over the next 6 months, let's say 12 months for now. That's one catalyst for a stronger dollar and a third theme or a third narrative. The other is widespread belief in Trump and him actually delivering on his growth proposals, right? So if he actually goes out and and boosts fiscal spending, and you do see much stronger growth, and you do see U.S. once again as a place where you want to deposit capital, then you could see a much stronger dollar. Now, the question is, fundamentally speaking, how will that be funded, and what will the market care about? So let's say he goes ahead and does what Republicans generally do, which is deficit-busting tax cuts. If the market begins to focus, and we don't have an answer because we won't until the market decides what it wants to focus on. If the market focuses on the strong growth and the fact that because of that strong growth, the Fed needs to hike faster and price in more normalization, you should see the dollar strengthen. But if the market focuses on the fact that, wait a minute, these aren't funded, it's going to really widen the budget deficit, and that is actually negative for the US. And if they focus on the deficit, then that actually means you're going to see a weaker dollar, right? So you're actually in a situation where we just have to wait and see. So we have to wait and see what policy will come forward. Would it be protectionism or spending? And then what would the market focus on and how it's funded? So we have multiple scenarios. We always operate with multiple scenarios. And whichever sort of makes most sense and ticks most boxes, we sort of go with that. And right now, I would say we're treating the dollar with our long positions as a counter trend move. So as a much more, let's say, a 3 to 6 month horizon. And we could end up staying longer in the trade, but we're not in a position today to determine that.
Okay, very interesting. And we have a little bit of time left. That was great coverage and, top elite fundamental analysis. Any other instrument or asset class you'd like to cover before we wrap up?
I think, I don't know if commodities is interesting for you guys or not, but I think oil is very interesting, and I'm the only guy I know who's bullish on oil prices, who has been so for the last 1 month. And I think we could see an oil squeeze coming, which could take oil prices well above $60 in the next 12 months. And there's fundamental reasons for that as well. I think a lot of people look at the charts and they think the charts
technical reasons too. There's your technical reason. Look at the screen. You have convergence of a few moving averages there, so we can learn from each other, right? And also, I have my cursor here, right here. This was a falling wedge formation, and 100% retrace takes it to 62. So I'm with you.
There you go. And
Yeah,
I mean, looking at your
interesting.
chart just right now, it actually even looks like an inverted head and shoulders pattern. If
Yeah.
you want to,
Yeah.
right? So
A lot of people
and I
thought we
think
might get one more dip under 40 for the shoulder to develop a little bit more, but that's looking less likely. So do we have a continued blow off in S&Ps, Jawad?
So I am of the view that over a cyclical horizon, right? So on a cyclical horizon, I think there's significant more upside in stocks. Significant. I think 15-20% upside in stocks still exists on a cyclical horizon. I think what I also sometimes pay attention to technically is the Elliott wave theory and just counting waves. I'm a very simple technician, so very much relying on moving averages, trend lines, and Elliott wave counts. So if I look at the chart that you've just posted up for your viewers, I think we saw wave 1 from 2009 to 2011.
Yeah.
I think wave 3 from 2012 to 2015. I think Q1 last year was the beginning of wave 5 to new highs, which is now super surpassed. And I think that wave can continue significantly higher because even though US has broken out, frankly, Europe is on the verge of breaking out. Japan has retested its breakout. So, I mean, I could spend hours discussing why I think technically and fundamentally stocks have significant upside. I do think over the next 3 to 6 months, though, we are completing, let's say, a minor wave 3. So you should see some pullback in wave 4. But that's probably an area where you want to buy as opposed to want to trade short, right? So I think that's significant. It's very easy to be bearish on stocks, but I do think the primary trend is higher for fundamental reasons as well as technical reasons. And I think you'll have more upside in non-US stocks than actually US stocks. I also have a very controversial view in that I think the secular bond bull market is over last summer. I think we saw a blow-off top last summer. And we've been bullish on bonds from December onwards, expecting a rally to continue through mid-year. We've sold about 2/3 of our long treasuries position at the end of June, but we've still maintained a few, like a third of our position. And that's basically because I think a lot of people are complacent about Fed actions in the fall. And the immediate reaction of what I think is going to happen over the next few months because of Fed balance sheet unwind is a tightening of liquidity. It's going to be weaker activity, economic activity. It's going to be weaker stocks and strengthening bonds in the short term, which is counterintuitive because you would expect that the Fed is unwinding its balance sheet. You'd expect yields to rise. But the market works in mysterious ways. And I think the immediate response, frankly, would be that bonds strengthen. So I think the next 3 to 6 months, the way we are currently positioned in our portfolio, for the next 3 to 6 months is we're short stocks. We're marginally long treasuries. We are long oil. We're long gold. We are building long positions with the dollar now gradually. So that's how we're thinking about it as of right now.
I'm really glad I reached out to you. And you're a great public speaker, and everything that it said on your website about you, you've demonstrated today. So I learned from you today, Jawad. So I really appreciate you coming. And had a fine
appreciate it very much, Dale. Thanks for having me and putting your trust in me as well. And I hope your viewers benefited from our shared discussion.
Okay, well, we definitely did, and maybe we could get back together later in the fall, see how things are playing out and what narratives you're focused on. I encourage people to follow you. I think you have a great fundamental feel for what's going on in the market, and it was a great presentation. So they could follow you on Twitter at JSMian, M-I-A-N, and they could go to your website to check you out. And you guys are money managers, correct?
We're focused on mostly research and ideas. The money management is mostly internal. So we don't take external capital. We just focus on research and trading ideas from a business standpoint.
All right. Well, I'd like to call you from now on my trading warrior brother, Jawad, and may pips rain down. May pips rain down on you and everyone that hears your analysis. Thank you.
Thank you very much, Dale. Good day.
Good day. That's it, Face. Hope you enjoyed it. I thought it was a great interview. In my extremely accurate and humble opinion, remember, don't just count your pips, count your blessings. Click the link for the trial so you know what Grega, I want to thank Grega. You know, Grega, the Wizard of Ways, came in here, gave you some looks. In Aussie, Euro Yen, Steve Volge, as usual, he's our Iron Man. No matter what's happening in his personal life, he never deserts his post. And who said the summer was going to be slow? It doesn't slow down bees, especially worker bees like you and Face. So don't just count your pips, count your blessings. We'll see everyone tomorrow for the BOE. Adios, my trading warrior brothers and sisters. Enjoy your summer day. You're welcome, Doug. Thank you, Jess.